Breakout gives me an opportunity to enter into a profitable trade. Learning about stops help me to square off the profits without entering into a loss zone. Retracement gives me the second opportunity to enter into a profitable trade which I missed to enter. So, what is breakout, stops, and retracement? Come on, let's see in this video. We have a resistance line, or we can call it as resistance zone. We have support line highlighted in red, and we have a trend line. When the price breaks the resistance line or resistance zone, support line or support zone, trend line is considered as breakout. If the breakout is in the direction of the trend, here we have the resistance line, we have a breakout. Breakout should always happen the extreme level of the zone. We have a resistance zone. Breakout should happen at extreme level of the zone. Then it is considered as breakout. Similarly, if the support line is price breaks the support line, then it is considered as breakout. And even if the price break the trend line, then it is still considered as breakout. If breakout is in the direction of the trend, then it supports the trend. If the breakout is against the trend, trader needs to reverse the trade or close his trade. Breakout is not sufficient. We need confirmation for the breakout as well. Breakout can be confirmed when the price closes below the breakout level. For example, here if you see, we have the trend line, breakout happened. There is a small area where the price moved below the trend line. This is not considered as a breakout. Just the wick of the candle moved below the trend line. This is not considered as breakout. When the price closes below the trend line. Here the price closed below the trend line. This is considered as a breakout. Few traders requested or needs two closing candle below the breakout level to consider it as a breakout. When a breakout happens, we need confirmation for the breakout. There are many ways to confirm the breakout. First option is to confirm the breakout is percent filter. Here the price breakout breaks the resistance zone, the extreme end of the resistance zone, but will confirm this breakout as a breakout if it crosses a specific percentage. It need not to be 21%, whatever the arbitrary percentage we have, we'll consider the price breakout only if it crosses the specific percentage. Right? Here I just had 21%, it can be anything. Time filter. Like as I mentioned earlier, the close of the candle below the breakout level here is trend line. When the close happens below for a specific period of time, for example, 2 candles, 3 candles, whatever it is. Here I consider if price closes below the trend line for 2 candles, it is considered as breakout, which is the second option of confirmation, which is time filter. Third option, when price breakout, if volume confirms the breakout, you can see a spike here, volume spike. If volume confirms the breakout, again still it is considered as one of the confirmation, and we consider this breakout as a legitimate breakout. The filters we reviewed were price filter, time filter, and volume based filter. Why we use this filter? To make sure to get a confirmation for the breakout. The drawbacks with the filters are these filters never consider volatility. What is volatility? Volatility is range of price movement for a specific period. Here we can see low volatility, meaning the price is in a lesser range, right? The movement is in a closer range. But in high volatility period, the price move extremely more compared to the low volatility period. So this is not considered for the previous filters which I mentioned earlier. What happens if volatility is not considered, if we consider only the percentage? The breakout happens, however, it may not be a valid breakout. So, what are the options to consider volatility? We have beta, standard deviation, and ATR. We'll look into it one by one. For beta, what is beta? Beta is the change in the price of a security in comparison with its market proxy. Market proxy can be S&P 500 or Nifty, etc. The advantage of beta is it eliminates the trend while doing the volatility calculation. We have another option which is standard deviation. We pretty much aware what is standard deviation. It's just a percentage of price change. As per theory, it is not suggested to use. Usage of beta and standard deviation is not appropriate. Consider it as a closing filter for breakout confirmation. Average, true range. True range is the greatest of either of three. Difference between current high and current low, or the difference between today's high and yesterday's close, or difference between yesterday's close and today's low. The greatest of either of one is true range. Once we compute true range, ATR is the average of true range over some time period. Either it may be 14 days or 21 days, whatever it is. ATR is an excellent measure of volatility and is used in many indicators as well as breakout and stop loss formulas. ATR will be used as a price filter for confirmation of a breakout by including a multiple of ATR. Here we already observed for Apple stock, we have the low volatility period and we have high volatility period. For example, if we want to consider a breakout of this box, in this period, what is ATR? I included an indicator named as ATR, which will automatically compute the ATR for us. Here, in this range of period where volatility is low, I'm going to consider 1.33 as per this indicator. So I given a buffer of 1.33. If price break out this level, then it is considered as a breakout. Similarly, for high volatility period, it may not be 1.34. It will be 1.71. Here, if you see in this indicator, the ATR is 1.71. As it is 1.71, I given a buffer of 1.71. Only if price breaks 1.71 or 8.34 percentage, then it is considered as a breakout. Here I just take one ATR. Normally it will be 2 to 3 ATR based on your testing and based on the specific stock. This is about ATR. Pivot point technique. It is a method to determine support and resistance, widely used by day traders to establish potential price ranges for the day and rarely used as confirmation for breakouts. This technique uses the previous periods high, low, close, and open. A series of points called pivot points for the current period are calculated from price points derived from the previous period. Thus, the most recent previous bar's action is the best predictor of the current bar's action. We have a specific formula to calculate this pivot point. Just follow the notes or just follow the book. It carries the formula information. So in this chart, you can see CP is the center point. S1 is support zone 1, support zone 2, support zone 3. Similarly, R1, R2, R3 will be there, which is resistance. Next, can a breakout be anticipated? Volume is a clue that a breakout is about to occur. Here we have the price reaches the resistance level. Here the expectation is the volume will be more, but when the price retraces, meaning when the prices comes down, to see if the volume is reducing, then we can get into this point. We can place our trade, and when the price breakout at B, we can add additional position. So C is an opportunity for us to enter, but there are risks involved. The price need not turn upwards. If it continues downwards, it's a risk for us. So how to prevent the risk? We should have stops. What is stops? We'll be explaining in the coming section. Stops. Stops can be used to enter a position or exit a position. First, let us look into entry stops. Here I placed a buy stop. This is my resistance line. When there is a confirmation, here my confirmation is when price closes above my resistance line twice, then I'll enter. So I place a buy stop here. What happens if price closes twice above the resistance line? I'll buy this stop. The system will automatically, whatever the system it is, the system will automatically place a buy order. The buy order will be at the market price, which is termed as purchasing at market price. Next, similar stop is sell stop. If I am selling the trade, if there is this trend line is a line below which if there is too close candle, I wanna sell the position. By selling the position, similar to buying the position, we can sell the position as well for making profits. So if I sell the position to enter, which is called as sell entry stop. This is buy entry stop and this one is sell entry stop. Buy exit stop. For example, I have a selling position. I want to square it off. Then if there is a confirmation that breakout is true, then I can buy the position which is squaring off my selling position. Similarly, if I have a buy position and if I have a confirmation that breakout happened, which is against my trade, I'm supposed to close my position. I need to reverse my position. In that case, sell exit stop comes into picture, which will close or exit out my position. Whipsaw is important concept. If you see the slight dotted line, I'm not supposed to place stop pretty close to the price. If in case I place stop pretty close to the price, for example, right here, I place the stop very close to the this candle at the wick of the end of the wick. I placed this stop order. What happened is my stop is touched, executed, and price moved upwards, closed upwards. So this is called as whipsaw. What is whipsaw? Placing stops too close to the current price action, and investor can be easily whipsawed. It occurs when an investor buys a security, the security price falls, the investor sells the security, and then the security price goes up above the original purchase price. Can we change the stop? We are not supposed to change the stop. It's not a honest way of executing or placing our stop. By changing especially when the security is trading at a loss, the investor is losing discipline. Trailing stop. When a security is in a trend, a trailing stop can be used to avoid the potential loss of profits. In this example, I placed a sell stop. I have a buy position. I'm trying to place a stop if price reaches this level. So if this is honest and if I'm sticking to this stop, I would have exited the position right at this level. But if I have a trailing stop, just observe this dotted red line, my profit would have been continuing further. This is an arbitrary line. Trailing stop can be drawn in parallel to the trend line, and the confirmation filter is similar to the confirmation filter we discussed previously for breakouts. There is another kind of stop which is Chandler exit. If you remember just few minutes ago, we discussed about ATR. ATR, average true range. So we'll take average true range and we'll use a multiplier. Either it can be 1, 2, 3, whatever it is, or a fraction, and point, we'll mark a point below the reversal point. So the difference between trailing stop and Chandler exit is Chandler exit is based on volatility. So when the volatility is low, the Chandler exit will be closer to the price. When the volatility is high, the Chandler exit will be further away from the price point. But when we go for trailing stop, it is a standard line, arbitrary line. It doesn't consider volatility. So always Chandler exit is little more superior compared to trailing stop. Trailing stop using parabolic SAR. SAR stands for stop and reverse. Parabolic SAR uses a acceleration factor that increases as the price move along its trend. Acceleration factor is arbitrary, whereas the factor instead of acceleration factor we can use ATR. However, still the factor we use is arbitrary, so it requires testing for each security. Time stop. There are time stops. Exit stops used to close a position after a predefined period of time, especially if the position is not profitable. For example, if I'm getting into a position and if it is not profitable for a specific duration, maybe for 1 week or 15 days, depends, then I'll exit out that position, which is called time stop. Money stop, for example, I'm investing $10,000 to purchase Apple stock and I have a buffer of $2,000. If I make profit of 10,000 and if I see I'm losing $2,000 out of this 10,000, maybe making only 8,000, then I'll set my stop at 8,000 as my target. This stop is based on the risk one is willing to take in terms of money. Using stop when gaps occur. Normally, gaps occur when the price of current day is much above the previous day's close. It creates a gap. The price of current day is much above the previous day's close. It creates a gap. So when price retraces below this gap, the understanding is the gap is false. In that case, I can place a stop near to the opening of the gap. So when price goes below my stop point, automatically my position will be closed because gap is considered to be false. Retracements. The trend rarely follows a line without including a number of small trends. The smaller counter trends you observe here are called retracements. The general rule is that strong upward trend requires retracement of less than 50% of the previous trend, which is arbitrary. Somebody says 33%, somebody says 66%, somebody follows Fibonacci. What is Fibonacci? We'll be discussing in the future lesson. But These smaller counter trends are called retracements, which is explained in the theory. Pullbacks and throwbacks. There are variation for retracement in the horizontal support line or in a resistance line. When there is a price breaks below the support and pull back, it's pull upward, then it is called as pullback. Similarly, in the resistance line, breakout happen on the resistance line. Need not to be a support or resistance line. It can be also be a trend line. In case of resistance line, if the price break above and throw back, then it is called throwback. The price touches back the resistance line and climbs upwards. This pullback point and throwback point are the opportunity for us to enter a buy trade in case of throwback, sell trade in case of pullback. Calculating a risk return ratio for breakout trading. Return, what is a return? Difference between the entry price and the price objective. What can be our objective? Any target price. Risk, amount the price may go against the entry price before exited on a stop. Usually some price on the other side of the breakout. What should be the ratio for risk versus return? It is 3 is to 1. 3 is to 1. Why 3 is to 1? This gives the investor the odds of making money even when 2 out of 3 trades fail. That's all about friends. Thank you for your time. See you in the next video. Bye bye.